This podcast is intended and contains general information on financial strategies, investments and products only. Whilst Luke and I are both licensed financial advisors, we don't know your personal circumstances, goals or objectives. We highly recommend that you reach out to your financial advisor or investment professional to discuss any of the topics that we've covered today before taking any action. Our full disclosure, copies of our financial services guide and additional information about Seneca Financial Solutions and Bold Wealth can be found in the show notes.
Hello and welcome to another episode of Wealth and Toil. My name is Luke Laretive and I'm here as always with my partner in crime, Dylan Pargiter-Green. DPG, how are you, mate?
2 weeks in a row, mate. You have nailed the last name. I reckon it's locked in your brain.
I think I've got it. All right.
And we are so proud of you.
Okay, we've got a pretty good and interesting podcast to talk about today. We're going to talk about boosting superannuation before retirement and a little bit about some specific issues that come along with being a lady in a modern 2024 and planning for families and superannuation and how we can make all that kind of work best for the punters out there. So
that's pretty topical. I think end of Feb we had the gender pay gap report come out. So first year it was properly released was last year, and then they've redone it this year. So they've taken basically every company in Australia with over 100 employees, taken their data and shown the difference between, pay gaps between men and women. We're obviously very, very much in favour of equal pay for the responsibilities of the job. People should be paid on merit. Look, interesting statistics. Apparently they're gonna do them again next year with a mean and not a median. It'll be really interesting when the CEO stats pop into there as well. Thought it would be topical.
It is topical. It's very topical stuff. I think it's often understated. It's a challenge for mums and parents more broadly these days, because the question is do I go back to work and pay the associated childcare costs and the significant, I would call it, life admin burden that goes with that, versus keep contributing to super, keeping my place in the workforce, continuing to progress through work, because if you fast forward 10 years, you might be much higher up the pecking order and up the salary order than you otherwise would be if you went out for a couple of years to have kids and came back. All these things are really relevant financial planning issues, and certainly an area of interest and I would go as far to say as passion for Dill and I. So we'll try and get into a few of those topics today and some more pertinent issues, and hopefully give you some practical things to think about. Should we do the markets, DPG?
Yeah. Or one other thing before we jump into that was it was International Women's Day last week as well. All the more reason that we thought this would be a good and topical podcast. We'll probably end up releasing this about a week late, but that's all right.
In our defence, it
was a long weekend. No, it was a long weekend. In our defence,
this isn't actually our job. We're doing this as a side project. So all your other finance podcasts are making squillions off advertising revenue and product revenue and God knows what else. And Dylan and I are here, just grinding away for you.
Yep, we unlike other finance podcasts, we give the people what they want.
We try.
I guess that's or what they don't want. We're just going to give it anyway. Let's go to the markets. Otherwise, I'm going to keep talking for
the markets.
Let's talk about something.
Let's talk about something important. The ASX 200 was down 0.24% for the week, so nothing particularly to write home about. Going into sort of quarterly reporting season into April was kind of the next kind of phase where a lot of the mining companies and smaller companies have to report quarterly cash flows, and also ex-dividend season at the moment. So a lot of stocks rolling off ex-dividend. It's a bit of a negative drag on the markets more broadly, but the main story from last week was the resources sector sell-off. We saw the ASX 200 resources sector go down 3%, 3.5%. Iron ore was down 4% last week in price move on that commodity, and I think the commodity's down sort of 13, 14% over the last 4 weeks. So we're certainly seeing a shift in, I suppose, what's been driving returns perhaps over the last few years. Been resources centric, to now, that cyclical industry kind of going into its kind of bear market, in my view, and prices sort of reverting to the mean, which, is going to mean a lot of earnings headwinds, I suppose, for some of these companies, particularly these sort of price-taking BHP, Rio, Fortescue type names, where they don't have a lot of opportunity to differentiate relative to other suppliers around the world. So that's the main news for the week on the markets. But Dill,
can I ask? Yeah, I had a client question from last week, but what's going on with lithium?
Okay.
So all over, I'd say what we call the renewable resources. But lithium's it's been a huge story. You've dealt so much in this space. But maybe quick update. What's going on with it?
History goes like this. Lithium prices for a long time were kind of under $10,000 a tonne for lithium hydroxide. They went up to $80,000 a tonne. And then they've fallen back down to kind of under $10,000 a tonne again. They've now started to rally a little bit back towards $10,000 a tonne on as the market sort of reaches some sort of supply-demand balance. Now, I think it's a podcast for a whole other day. I've written about it extensively in the weekly note. And recently on Rask, I put up an article as well, or Ben did, but that sort of, it's my work, but Ben posted it. I'm just trying to, give the young bloke a bit of credit. So that is, our thesis is there. I won't go into it. We think it's the structural bottom of this market for a number of reasons, which I outlined there. It's very similar to the coal market when I was working in coal. It had a period where it became, digital volumes of the commodity went up a lot. Too big a topic for the day. We're still very bullish lithium, and we think there's a lot of money to be made in that space over the next 5 or 10 years.
Good to know, because so am I. And we talk about that a lot, particularly for our clients that want to be sort of more renewable energy focused. Some of the responsible investing clients, we talk about the fact that you don't have to be ex-mining to be a responsible investor, and lithium's a great example of that. So huge. I think it'd be a great topic to do again in future, because it's on my mind.
We can do that. We can do that anytime you like, Dill. But it is a it's a deep dive. So we'll have to get into it in more structured detail, because It's
a deep dive. It's a deep mind.
It's a deep mind. Oh, look, very funny. But I can waffle on about this forever. So we'll push on, Sammy, and
not what we're here to
talk about the importance of superannuation. Dill, can we talk maybe first off for the younger folk out there? Now that's probably even younger than you and I. But we are still quite young, though. Handsome sort of individuals we are. But
absolutely.
Could you maybe talk to us about the importance of getting started early with contributing to super, and how people can do that on a year-to-year basis?
Getting started early. It seems like superannuation is so far away when we're 25. But the reality of superannuation is that it is something that benefits significantly from early contributions. And we don't have to necessarily put an additional 10% of our wealth away to actually make a difference. You can put $20 a week away. Will you notice $20 a week coming out of your pay? If you're working in your first job out of uni, if you're working hospo, if you're working, on the side while you're studying your masters, or you're just working a casual job because you don't know what you want to do yet, doesn't matter, right? Starting early and putting a tiny bit away has a huge compounding effect over the long term. And that comes back to what we talk about, having that sort of capital base, where the sooner you can build up a base of capital, the faster that it will start compounding at a rate that it is equal or greater than what you're contributing on a regular basis. Now, this is a topical, it's a topic that's particularly poignant for women, and the reason being that, more often than not, females who decide to have children will spend an amount of time out of the workforce caring for that baby. It's something that I personally hope to be able to spend more time out of the workforce myself and spend some time doing. Luke's decided to do a really great thing for the world and not have children.
I don't want to say I'm allergic to responsibility.
Yeah, allergic to responsibility. But the effect of maybe putting that little bit in extra now can mean that there doesn't have to be as much of a gap if that later on if that later on time you do spend a few years out of the workforce for whatever reason, kids or otherwise, it could mean that you don't lose as much of the compounding value of superannuation.
And Dill, obviously, if you are out of the workforce for the child rearing purposes, for lack of a better word, obviously, you're not going to be contributing to super as much as you probably otherwise would have been. Can you talk a little bit about? Look, you can do spousal contributions. Can you talk a little bit about how Mary and Bob, average couple, might be able to go about doing that, and what the benefits to them could be longer term?
Yeah, absolutely. So, spousal contributions are basically where one partner, who is the working or higher earning partner, can separate some of their concessional contributions from their work up to $3,000 a year and put that instead of into their nominated superannuation fund into a partner or spouse's superannuation fund. The benefit of that, particularly in years where we have, low or no income. So generally we talked at low or no income around $40,000 or below because of the marginal tax rate that you attract at those levels. What we then find is that being able to split that $3,000 into a spouse's superannuation may mean that they then eligible for the low-income government co-contribution, which is basically $540 for free from the government. So the government contributes an extra $540. You're still putting the exact same amount into superannuation as you were otherwise. It's just going from Fund A to Fund A and Fund B, plus the government's contribution. So it's a really good way of thinking about. A really good way of thinking about it is you're getting a tax break for putting your superannuation into a second superannuation account. At the very end of the day, superannuation is a joint asset, right? You're both going to be drawing from this pool of investments, which, hopefully will provide you enough income to live a really happy and joyful life in that retirement. But by making these little small steps during those times when income on one half of that relationship may be smaller, you might end up with a few $1,000s extra that compounds over the next 30 years. That could be a one-off trip to Spain for a holiday or whatever it might be. Right?
Dill, so let's move up the income tree marginally, shall we say. Let's talk about probably more representative of both of our client bases, those earning higher incomes, those with higher superannuation balances. What can they do to, when you're in the top tax bracket, what can you do with super to reduce your taxable income? And what can you do to help your spouse out in the event that they're, looking after kids and maybe don't have as much in super as you do?
Yeah, 100%. So I think this is probably where we'll spend a fair bit of time over the next 10, 15 minutes talking about some of the reasons why planning early for this stuff is really, really important. And it comes down to a couple of different pieces of legislation that we end up dealing with a fair bit. So the first one is something called the transfer balance cap. So taking a step back, we've got superannuation, which at some stage into the future will become a retirement income asset. So that retirement income asset will generally take the form of what's called an account-based pension. And the difference between accumulation super and an account-based pension is the tax environment in which they're treated. So an account-based pension moves from a 15% tax on earnings or a 10% capital gains environment through to a 0% tax environment. Now, that's a really big change, particularly when we're talking to some of those people, some of our clients who are in that sort of $1.5 to $2 million to $3 million balances. We want to make sure that we get the appropriate amounts into these 0% tax environments, because you're getting a 15% uplift on every dollar that you earn then, right? So that's an important thing to understand. And what is also important is that is per individual. So each person has a $1.9 million limit that they are able to put in as contributions into an account-based pension or a 0% tax environment. That does increase ever so slightly each year if the government decides to stay with its policy of increasing the amounts that are allowed to go into a 0% tax environment, which is the transfer balance cap that we're referencing. So obviously, where one person has the majority earning throughout their working life, they're going to be getting maximum concessional contributions. So at the moment, it's 27.5 a year. Next year, if the legislation all goes to plan, it's going to be 30 grand a year. It'll probably continue to go up, but they're going to build superannuation at a pretty good rate and potentially get to a point where they have more than the $1.9 million in superannuation, whilst the other partner in this environment may be earning a lower amount, in which case
working part-time, or in and out of work, or having to look after kids,
working part-time,
blah, blah, blah.
Having to look after kids. It also can just be a situation where you've got, what were they, Mary and Jane, or Bob and Jane, or who Bob Jane T-Marts.
We're not doing free.
Whoever it was.
We're not doing free advertising. If Bob Janes want to get a mention on this podcast, they better fork out some cash.
Yeah, get a set of new tyres for Luke's Land Rover. No, but if one of them, like let's say that Jane's a very successful psychiatrist and she works and earns quite a lot of money throughout her working career, whereas Bob owns a cafe, down the local surf club.
Okay.
Amazing. Yeah, down Torquay. You know it well. But let's say that, generally speaking, hospitality business owners don't put a lot of money into superannuation. Bob loves his job, does really well. They're not financially, they don't need too high incomes. But during that time span of their working careers, Jane is going to accumulate significantly more through her regular pay from hospitals and client billing and all those sort of areas. Whereas, Bob may or may not put some money into superannuation. And if we get to the age of 60 or 65 and we haven't thought about this before, there's only a limited amount that actually we can get from one superannuation into the other in time to ensure that we've got enough to make sure that both of those people are able to have the benefit of the $1.9 million.
Look, this is all pretty much just there's a bunch of superannuation rules, right? And they apply to different stages of life, and they apply to different people at different times. What you want to do as a couple is maximise the free kicks that the government gives you based on the box set of rules that they roll out. So, Dill's job, my job is just to find you the avenues that are available to you and make sure that you maximise those every year as you're accumulating wealth during the sort of, working years, for lack of a better word. And then as you transition to retirement, making sure you take advantage of some of those transition period benefits that are around. And then in retirement, ultimately generate the most tax-effective lifestyle income and have the assets that you have, when you do pass away, transfer as unencumbered and cleanly, and as you aligned with your wishes as humanly possible. And that is sort of the the macro version of what Dill's talking about. The micro, sure, come and get a bit of advice and we can sort that stuff out for you. But I think that it's important to remember why we're talking about transfer balance caps, and we're talking about concessional and non-concessional contributions, and we're talking about spousal contributions, because it is in totality all to do with just reducing your taxable income while you're working, and then generating as much tax-effective income in retirement as we possibly can. And it is that simple. I think everybody gets the benefits of saving money, and compounding and all that. And I don't think we need to get into too much math on how compounding works. You can just type it into Investopedia or whatever. But I think it's just important to give people the macro as well. The why of we're talking about this stuff, because it is really important. It is really important.
Well, so there's probably one other thing that I wanted to note on that. So just so everyone's aware, that the concept that's important to recognise when you are in that situation is you can do something that's called superannuation splitting. It's probably a little bit like lithium and a little bit too complex to talk to on a Tuesday afternoon podcast. But if this is your situation, really highly recommend that you go and speak to somebody and think about what the, picture 10, 20, maybe even longer years away might look like, because that's something that can have a very, very significant impact on, your overall asset growth and therefore your income in retirement. The only other thing that I really wanted to touch on was the legislation changes last year around balances over 3 mil. So you would have been across these, Luke, with the new tax changes.
Talk to me.
That came through. So really blankly, basically, people with over $3 million in their superannuation, which isn't a high percentage of Australians.
Hopefully it's a high percentage of my client base. If you do have more than $3 million in super and you want to come and have a chat to me, feel free.
Please call Luke.
Yeah.
No, but basically, it's not a high percentage of Australians. A lot of it's in SMSFs, and a lot of it's very heavily weighted into sort of family office clients who have numbers of properties and things in those. The change was that the tax rate was going to go up from 15% on superannuation balances not included in that transfer balance cap into the tax-free pension. So the monies that aren't in there, it's going to go from 15% to 30%. So that didn't actually upset that many people. They were like, you know what, okay, yes, if they're earning significant amounts of money in that superannuation environment, fine, a little bit of extra tax. They're still paying significantly less than what they would be if it was in their personal name. It's probably 47 cents on the dollar. Mm-hmm. So, okay, they can probably cop that. The main thing that was a worry, and this is why, if we're talking to people that have this level of balance, we need to think about how that money is invested. And why it's so important is because the change to the legislation for the first time ever is going to tax unrealised capital gains. So this is still draft legislation, but it's very likely to go through.
Is it let's not get into the politics of it all, but is it actually likely to go through, Dill? Because I'm under the impression it's not.
Yeah, I mean, I think that it's very likely to go through. It'll then potentially, it might be repealed in certain ways, and I think that this is one area that's been very, very unpopular.
I think it's ridiculous,
to achieve
personally.
The sort of things
Ridiculous.
Absolutely. And really, really rough calculation, right? So here's an example of why it is ridiculous. Let's say that our good friend Mary has $2 million in a superannuation fund, in an accumulation fund. She has 80% of that in a diversified, balanced portfolio. She's 60 now. She's starting to reduce her risks, maybe taking in some more fixed interest style assets, and she has 20% in, I don't know, let's call it company XYZ.
CSL.
CSL. Well, probably not. All right, let's use CSL. probably better to use something like Nvidia or Bitcoin. But but let's use CSL. Now, let's say CSL all of a sudden comes up with a cure for
Cancer.
leukemia,
Yeah.
right? Cure for leukemia. CSL price goes from $280 or whatever it's sitting at today to $5,000 a share, right? Like just like that, immediately. The problem is that her balance will have then gone from, say, $2 million to $7 million. Let's just say that's the maths behind it, right? It's not exactly right, but whatever. Now, her balance has gone to $7 million. She's going to be taxed at that new rate, and a lot of that new gain is unrealised. So she doesn't sell the capital gain that she's made on CSL. She still holds that share, loves it, wants the income, no worries, happy to get taxed at 30% on the income. The problem is that gain from $300 a share to $5,000 a share or whatever I said is then taxed at that rate in that year. Now, there's nothing to say she has to pay that tax. Maybe she pays $100,000, $200,000 worth of tax in that year. She can make the super fund pay it, but it's still her money. Let's say that on the 1st of July, the following financial year, that all turned out to be false.
Drug trial.
Someone's treatment doesn't go as well.
Blah, blah, blah.
Drug trial doesn't go well. CSL price falls back to $200. Well, she's paid the tax.
Hasn't received the benefit.
But she doesn't get the money back on the loss that she's made.
Because she hasn't actually made a loss. She's gone back to zero. Gone back to square.
Yeah, she's gone back to zero, right?
Yeah.
So she has an unrealised capital loss from a point in time, but she never actually realised the gain. So it's a yo-yo in this scenario.
My issue is
taxing unrealised gains is really, really dangerous.
I think it opens up moral hazard as well, Dill. There's a moral hazard here, and that is that if you own unlisted assets, and whether that's property, unlisted anything, there is a moral hazard to not mark those assets to market appropriately, to report them inaccurately, and it's difficult to for anyone to run around and say they're going to get fair, independent valuations on privately owned assets. I think it just opens up a Pandora's box of moral hazard, and I just think philosophically you're correct in the sense that you can only tax income that exists, not theoretical income. I'm definitely a big proponent of them not putting this piece of legislation through or changing it dramatically, because it doesn't make any sense to me personally.
Well, it opens up Pandora's box as well, right? So, like, we have some of the largest private unlisted infrastructure and private equity holdings in some of the largest superannuation funds in the country, who some of do their own valuations. Now, if I'm one of their biggest members, if I'm Joe Bloggs with $20 million in Australian Super, I'm probably going to be calling Australian Super and say, hey, probably don't value that just as highly, because it's not as beneficial for me for you to do that.
Well, I mean, okay, put that to one side.
Implications.
It's not going to. I mean, no individual is going to tell Australian Super how to value or not value things. I just think there's a hazard in the sense that Australian Super could, isn't incentivised to accurately report things because they have to pay extra tax and reduce after tax returns. I also think that, from a philosophical standpoint, it's going to be very difficult to administer for anyone who doesn't own just basic shares. And even then, I mean, I've owned plenty of shares that have hypothetically made a gain in one financial year and then, gone backwards in the following financial year. And I'm essentially being overtaxed. So, I think it's not the right way to do it. There's other ways to generate additional revenue, tax revenue that's more equitable, more fair, makes more sense, and is practically more enforceable. Because I think at the end of the day, if a law or any law isn't very enforceable or difficult to enforce, it makes it a lot more challenging. Dill, can we just move on maybe from legislative change to super. And just quickly, look, we'll probably do this on a full episode another day, but basic. Okay, so let's take our couple. Basic going, transitioning to retirement. What are 3 quick things you should be thinking about once you hit 60 that's unique about being 60 rather than being 58 or 59?
The golden years. The golden years, as we call them, the age of access. So look, there's a number of different things, but probably the main one is these are the years when your decisions on your capital matter the most. So if you look at your entire superannuation growth journey, you've got the most in superannuation probably that you will ever have or ever have had up until that point. So if you're not making maximum contributions at this time, now is your opportunity to do so, and it shouldn't cost you a cent. So really common strategy that we do for a lot of our clients who are in this situation is called a transition to retirement. And what we do there is we're putting money into superannuation pre-tax up into the concessional contributions cap. That means that it comes out of your pay before tax. You only notice the after-tax impacts, and then you top your income back up with after-tax dollars from superannuation. You set up what's called a transition to retirement pension. You get the same amount every month or every fortnight or however often you want it. And the effect of that is that you're just taking the tax difference between what you would have been paid in your personal name and putting that money into superannuation. Accumulate that over 5 or 7 years or however long, and it makes up, generally, it turns out to be quite a fair hunk of money. That's probably number one. So look at, if you're not making concessional contributions up until the concessional contributions cap in that year, that's a really good time to start. The second one is you are about to enter the time when you're decumulating. So you probably need to review your investments, and you need to think about why maybe thinking about some capital preservation and reducing the exposure to those more volatile growth assets might be a good idea. Now, it's not going to be a good idea for everyone. Some people might actually really need the next 7 years of higher growth and need to take that risk to be able to draw the income that they want. But, I mean, look, how many 65-year-olds have you got 100% in equities?
Not many. And I think it is horses for courses. And I've said this before, some people find they're quite comfortable with the sequencing risk and they've got more than enough money, so it really wouldn't matter what the markets did. They've been in equities a long time. They like the higher returns. They know, they've got more than enough. I think if you don't have more than enough, there's certainly scope to be reducing your risk profile and ensuring that you're meeting the lifestyle requirements. Or you're likely to meet the lifestyle requirements that you have in retirement. And certainly there's plenty of scope these days to generate really solid, mid-single digit returns from relatively low risk investments. So if your requirements are only that 5 or 6 or 7% through the cycle kind of returns, you don't necessarily need to be wearing the volatility of equity markets to achieve that kind of result. So whether that's through investment grade bonds, alternative product, or even if it is through equity income style product, infrastructure, property, those kind of things, I think there's certainly enough there for people who do have those sort of more modest return requirements to transition their portfolio, still generate a really good return, still be going forward every year without necessarily having the sequencing risk. And what we mean by sequencing risk is essentially the GFC happens the year you want to retire.
So probably the third one, which takes it, sums up those 2 points, is figure out what the actual income need that you have, figure out where your different assets sit, and look at whether or not there is any government entitlements available to you when you reach that 67 and somewhat start planning for them. So, a lot of our clients will take a significant hunk out of their superannuation and give it to their children as a gift. So adult children trying to buy into, break into the property market, things like that. Now, gifting is a wonderful thing, but it actually has consequences for a part of your income later on. So if you gift something now, it stays on your asset base for Centrelink purposes for 5 years. So that's something to consider there. You want to make sure that you don't get there and then be penalised for something that you've done but could have planned to do it a year or two earlier. The other one is, thinking about, well, okay, if I maybe repay some debt now earlier, does that give me the additional cash flow and therefore capacity to contribute additionally, get the tax breaks that we were talking about before? So that, like 5 to 7 years after 60, when people are deciding to retire, slowing down work, whatever it might be, in their personal situation, we need to think about what that point of income need is and then figure out the appropriate assets. We could look at annuities, some of those more defensive assets, so that we can be more aggressive. We can think about taking a chunk out of superannuation so that we don't hit, $3 million and go over that unrealised capital gains that level and start gifting to people earlier. So there's a whole range of different things, but at the end of the day, superannuation is an income asset. So all of those things will have an effect on what the income that you can draw from. And if you're leading up to retirement, do as much as you possibly can in those 5 years to protect your capital and build that capital base so that you've got as much as possible to draw.
I think it's a really good place to wrap for today. Mate, very knowledgeable you are in this area. So thank you very much for your insights today. Much better than me on this stuff. So look, if you do have questions about superannuation, whether that's in the accumulation phase or in retirement, or particularly that transition to retirement where we both feel we can add a lot of value for investors and for listeners. So if you are interested in having a chat with us, please feel free to reach out. The email addresses and our contact details are in the show notes. Otherwise, mate, have a fantastic week. I will hopefully see you next week. I think we might be doing this in person.
Yeah, I hope so.
Check the schedule. Check the diary.
Check the diary.
That's it.
Check the schedule. Oh, no, next week. Is it next week? No, next week. Week after. Got a couple of special guests coming on the podcast.
We're doing the Equity Mates boys are going to come on for a couple of an episode, maybe two. We'll see.
They're going to come on. Luke does for anyone that doesn't know, Luke does a segment on their show called Pimp My Portfolio, and they're much better podcasters than us, so I reckon they can come on and do Pimp My Podcast.
Grow our audience.
Help us do a few things.
Current download 7. Okay, very good. Mate, have a great week.
7. Take out me and you.
See you, bro.
Have a good one, mate. See ya.